Welcome to Beyond Wealth, Success Unscripted with Matt Calnan. Discover the personal drive, professional journeys, and business strategies that have made a real impact. It's success from the inside out.
Welcome back to the show, everyone. Today we're chatting with Darvin Zurfluh, the founder and CEO of Pinnacle Wealth Brokers, a leading national exempt market dealer. With over 20 years of experience in investments and real estate, Darvin has earned prestigious designations like a Fellow of the Canadian Securities Institute and CFP. He's a pioneer in alternative investments and has built Pinnacle into a top firm in the country. So first of all, welcome to the show, Darvin. And do you want to start off by telling us a little bit about yourself and what you guys are working on?
Awesome. Yeah. Thanks for inviting me, Matt. Darvin Zurfluh. So as Matt said, exempt market dealer is our core business, and it's alternative investing. So with an alternative into private companies across Canada, sometimes in the United States as well. Private businesses are looking for debt or equity capital to help grow their business, not startup businesses so much, but businesses that already have been running and proven the management experience and that are just looking to grow to the next stage. So that's been the core of our business since we started the exempt market dealer.
And can you maybe dive into a little bit about what your background is? Like, how did you get into the wealth management field? How did you go about the founding of Pinnacle? What does that look like?
Yeah, so when I was going through business school, I knew I wanted to start my own business, and I needed to save some money to get going on a business. So I had some ideas and ended up taking a job at a bank. So in the 90s, I worked for two of the largest banks, the late 90s. And from there, I just worked my way up. I took all the courses, and I took a keen interest to investments and decided I want to do my CFP and took some additional courses on top of that. And so that helped me propel into saving more money for going out on my own. And what I wanted to do started to shift and change a little bit over time. But ultimately, I started going on my own by having a financial practice and just doing financial planning and offering investments and insurance to my investors. But then I came across these alternative investments, and it was where I was making my money. I was making a lot of my money personally on real estates, more than I was on, say, mutual funds. And then I started investing in real estate investments with third-party private companies. And I started talking to some of my wealthier clients about it, and that's what they wanted as well. And so there was no exempt market dealer option at that time. So that's just what opened up the opportunity as an entrepreneur was, hey, I was talking to other financial planners that were now saying, can I invest in that too? And they ended up becoming my clients. And so every RSP season was super busy because they were putting their money into my products, and then they're selling their clients mutual funds and other products. So that's when the light bulb went on. I'm like, half of my clients now are just other financial planners and advisors. There must be something to this. Let's look into it more. And basically, I was on a drive on the QE2 late one night after seeing a bunch of another financial advisor's clients, and thought, well, let's set up a brokerage channel, kind of like the MGAs were doing in the insurance world. And ultimately, when we started it, we were called it Alberta Land and Investment Brokers, and it was Alberta-based. Most of the investments were Alberta-based. And we grew quite fast. In 2009, we were rated the fastest growing company in Alberta under 20 million category by Alberta Venture magazine in their magazine that they had out at the time. And then their new rules came into place, and I think it was on the radar for securities commissions. It was a different, basically, for the most part, unregulated, and they were looking at formalizing that. So much like with the IROC channel or the mutual fund channel, put some formal regulations in place, and we had to make a decision on how we're going to grow from there, how we're going to handle that, and so we decided to go national, and it was in 2009 when we changed the name to Pinnacle Wealth Brokers and looked to expand our reach. We already had advisors in BC and Saskatchewan by that time, and then over the next couple of years just went across Canada to Nova Scotia. So that's
awesome. Honestly, that's a really, really good overview of kind of how you got into that. And you're at the,
Yeah.
I'll call it the pinnacle, not for the fun there, but the pinnacle of the EMD world, right? Kind of right at the start of everything going on there. Can you maybe explain what an exempt market dealer is? And you did it a little bit there, but what an exempt market dealer is, and maybe compare that to what we would typically think of as a financial advisor.
Yeah, I think the basic definition is it's exempt from a prospectus. So if you're selling something from your typical broker, if you're investing in something, you got a prospectus, and it's usually tradable on a public exchange. And so that's your big legal document with all the disclosures in it. So the exempt market is exempt from doing a full prospectus, and they have to do other forms. Most commonly, we use the offering memorandum exemption. You can do ones that are like confidential information memorandum for accredited investors. So that'd be a shorter form document yet. And it's just a little bit of a smaller document, a little bit less disclosure, and it's not reviewed and approved by securities commissions. It's something that you're relying on the business owners who write and sign off on the disclosure documents that you're investing with. Most commonly offering memorandum, and they're typically available in registered plans like RSPs or TFSAs and those kind of things as well. So
You're able to sell a product that mimics a public entity without having the same compliance requirements behind it. Is that fair?
that's right, yeah. And I would say most of the compliance standards are the same. When they started with offering memorandum exemption, it was drastically different than it is today. There was no audited financials, for example, and years ago they put in audited financial requirements, and so and that's under the offering memorandum exemption. If you're going under the accredited investor exemption, there may not be a requirement still or there isn't a requirement. That would be up to the issuer if they decide to get them audited. So that's probably one of the biggest differences. But yeah, a lot of the companies that we choose to deal with operate very much like a prospectus company. So they have independent directors that sit on the board, and they deal with conflicts in a similar manner than a public company would as well. They're just operating a smaller manner. They have a smaller budget, and trying to keep the costs a little bit more affordable, because that does ultimately just eat away at the investor returns. So you got to find that balance of how much should they spend in good governance and structure versus what is it going to cost you on the side of your investment returns.
Yeah. You made a comment about a lot of your early clients were other financial advisors, and that is not atypical from different exempt market dealers that I've talked to. A lot of them started out that way, and there's always an irony to me that the financial advisors are not able to offer themselves or their clients the same products that they're themselves going into. But
yeah, exactly.
In that exempt market world, these exempt types of assets or companies, can you explain what those alternative assets might look like? And you did from a high level on a business or real estate, but what does that really look like compared to being able to buy into Apple?
Yeah, I mean, the biggest difference is, like I said, they're smaller companies. They're not on a stock exchange, so you don't have that ability to say, I want to get out and sell it like within minutes. Whereas on the public market, one of the example is we offer a lot of REITs, so real estate investment trusts. We've liked dealing with those for the last 17 or 18 years. They've done well for us, and you can get those on the public market, or you can get them on the private market.
Yeah.
And so some of the private market ones might have less volatility in them because they're not trading on a daily basis, and they strike their NAV typically on a quarterly basis. And they may only do a evaluation of certain amount of their buildings on a regular basis, and so they'll keep rolling through them. And so you're getting a more of an estimated net asset value than you are on a trading price on the public market. But the underlying investment would be similar, and you just have to choose which managers you're going to like better, and do you have the time horizon to be in it maybe for longer because it may be less liquid. And but yes, overall some of the investments can be very similar, We have a music royalty fund, so something that's that's different. And again, it started out as a business entrepreneur with a really good idea, good contacts, and they can buy into certain songs and get the ongoing royalties on those songs. So for a company like that to do it on the public market, it would just have more costs up front to get going. And the public markets haven't been that liquid for smaller companies. And so to have all those additional costs and burdens of going public, it can actually sink a small private company. Whereas, on the private side, they can raise what they need, control the amount of cash flow to a certain extent, but they don't have those extra costs in case they don't get to scale. Because, they might need to be at 50 million or 100 million to scale, or the costs are too high on the public side. But if they only get to 15 million, it might make sense for them to do it on the private side.
Yeah. Yeah. And I read this probably a couple of years ago now, so it might be outdated, but I'm sure it's still accurate, is that there's actually a decrease in the number of public companies on the TSX and the New York Stock Exchange. So historically, we've always seen an increase. And I think it was about 10 years ago that number started going down. And again, up until 2 years ago, or around 2 years ago, it was still going down. I assume it's doing the same. But I think a lot of that comes because of the cost, the complexity, the governance requirements of those public companies. And not to say that that's bad. I think governance in public markets is a good thing, but it does become very, very cost prohibitive to a smaller medium enterprise when you're looking at maybe $1 million to $2 million per year in additional cost to go and enter that public market world.
Yeah, exactly.
Why would this be an attractive avenue for an investor, and whether that's an accredited investor or somebody putting away a little bit here and there for their retirement?
Yeah, I think diversification is number one. You can invest in the public market, and the market will move sometimes for different asset classes all in the same direction based on market sentiment, based on changes in investment policy. Interest rates change, and then people get more confident or less confident in the market. And so, but you could also invest in something a little bit closer to home, where you can get to know the managers and the assets within whatever the private company may be. Often you can go tour the properties and get to know the business, get a little bit more involved, and learn from it. You can learn from lots of different kinds of businesses, and there are different investments that you won't find in the public market.
Yeah, and let's jump back to you a little bit on kind of your founding of Pinnacle, and what are some of the challenges that you went through in that transition of founding the organization, and maybe over the last whatever it's been now, 15 years, I guess, of changing security laws and all of that.
Yeah, there was lots of challenges for sure. At the beginning, it seemed like there was just an enormous demand for these alternatives, and it seemed rather easy. But then after you get going and you offer lots of different investments, your business grows, you have more demands, and things don't always work out the way that they're supposed to with different investments. So that's when you run into the challenges. Is usually a few years later. Okay, well, you got diversified. For clients that have a nice diversified portfolio, they're probably doing well, even if something didn't work out. But of course, you have to deal with, okay, well, if it didn't work out with this one investment here, did the issuer do what they're supposed to do? How do you're an intermediary for the investor and the issuer, and you don't have control over them. We're the broker, and so we're kind of in the middle. So you deal with some challenges that way. Eventually, we might be offering 15, 20 different products at any given time, but 5 years later, with all the historical products plus what we have on our shelf, it starts to be quite a lot of different options, a lot of different products we got to keep up to date with. In the early years, probably even the bigger challenge than that was the regulatory, when they put in all these new policies. And we in Canada, we're not regulated by national regulator, right? So we have we have 10 different provinces that for us that, that we're dealing with, and it was rather new to all of them. They were learning. And so because we were the biggest one at the time, I think they were using us to learn by doing their reviews with us, and they would take longer because we'd have to answer a lot of questions. And it really did hurt the business because we were focused so much on going back and forth with regulators and them trying to understand this new world that they have to oversee. And, their responsibility is quite large in that. I think in Alberta, there was over 100 applications in the first year for an exempt market dealer. And I think it was over 500 or 600 in Ontario. So like with all the different provinces, it became something that they had to get on top of right away. And I think they used us as a bit of a resource. And then over the years, things change. Like every year there's new rules, new regulations to stay up to date with. So for us, we have to adapt at our head office level, but we don't have our advisors in the head office. So we have to make sure that all of the advisors or the dealing representatives are learning the new rules, following them, and then providing oversight to for us to have good books and records and prove that they're saying what they're supposed to be saying to investors. And so that's challenging because, again, you're in the middle as an intermediary. You don't really have the line of sight that a regulator might expect that you would have. So it can be quite challenging to please everybody in the exempt market dealer world, being in the dealer side.
Yeah. I'm a big fan of the exempt market dealers because they have access to a lot of different products and that we'll say historically people have not had access to, and there's really good returns that can be made there. Typically a little bit higher risk, which is why there's a little bit more due diligence, I think, that goes into some of the investor side and looking at the offerings themselves. But if you were to give kind of the 30-second pitch on why somebody should be looking at an exempt market dealer versus just using, say, their typical financial advisor, which might be an IROC dealer or might be MFDA. If it's at the bank, they're probably an MFDA licensed individual. Why use the EMDs over those classes? Or sorry, maybe not why use exclusively EMDs, but why would you add that even to your portfolio?
Yeah, I think that you got it right on there, Matt. Why add it? It's not to not use, the traditional investing approach. It's to diversify and get into other options that you might not otherwise have access to. And by using exempt market dealer, you have someone that's been looking at these kind of products and look at what can go wrong. They work with issuers to make sure they're structured in a fair way for investors. They look at the valuations of the company. They look at those, what's experience of the directors and the management team. And a lot of people like to do that on their own, but you can learn and make mistakes as you go. So why not go with companies that have looked at hundreds of companies, like an EMD that's looked at hundreds of companies, versus try to learn on your own. So learn through the dealer and how to choose those investments, and choose a dealer that's got the experience. There's lots of newer ones out there, and there's lots that have been around for at least that 14 years since regulations have kicked in. And so if you choose one that's been there, I think you have a little bit of a better chance of, like, they're going to choose solid investments. Typically the larger dealers get first choice at funds that want to raise more money because they'll go to someone that has more dealing reps that can raise more money versus a smaller dealer that might be just doing something very unique, but they might not be raising very much money for a fund.
So what does that due diligence process look like on Pinnacle's end? Because I'm sure you guys get approached all the time with different opportunities that are out there. How do you go through that due diligence and say, this is what we want to put on our shelf to be able to allow investors to invest in?
Yeah, that's a great question. So typically we break it down into three different parts. So there's a legal due diligence, a financial due diligence, as well as the business case due diligence, which is, what is the marketplace that they're in? What's the economics look like for this kind of investment? And so, starting with legal, making sure, is it structured in a way that it's supposed to be structured for, say, the offering memorandum exemption is typically what we're we're looking at. So it's got a proper legal structure. If they say it's RSP eligible, is that truly RSP eligible? Because you don't want that winding down on you. If it's not, you could be dealing with some severe tax consequences. So legal due diligence is very important for a lot of different reasons. We typically look at the directors and the independence of the directors, and then also verify the people and their backgrounds. We do credit checks. Those kind of things are some dealers do and some dealers don't. Criminal record checks, and just really looking into kind of who are we dealing with. And then financial due diligence is, we have CFAs and CAs that will look at the model of the investments. Does it make sense for investors based on their business case and where they're projecting the company's going to go? And then we have to follow that to see if they are doing that. And that's the hardest part, because if they're not doing it, you've already had the money in. Then you got to figure out how are you going to deal with that, because they've already now spent the money, and maybe it's following or maybe it's not following exactly what they said that they would do. But you need a team of people to be able to do that. And it becomes a labor intensive on the financial side. But we have CFAs with really good financial modeling experience that will model out these, and then on the business case side, just understanding other businesses. So we'll do a comparative market analysis and see, okay, how are other businesses in the same sector being valued? Are they trending up? Are they is it pretty flat? Or does it make sense for us to go into this for typically a 5-year period is kind of the average, but whatever they say, they might be doing a longer term or a shorter term. And so ultimately a lot of it does rest on those financial analysts that do the homework on the product and go back and forth with question sets. So they send them a whole bunch of questions. We rewrite sections of the offering document so they're worded in a way that we feel gives us some comfort that it will keep them in their box and their swim lane, so to speak, of what they set out to do. And the wording is clear. Plain and clear language is also very important, because I always say to investors, if you don't understand the investment, then don't invest in it. Right? You need to understand it, and of course the issuers have to be able to portray what they're going to do in clear and simple language. So
yeah, that's actually a really good point. I've read quite a few offering memorandums in my life, too many actually. Probably not nearly as many as you have, but they're not a super fun read because they're typically quite long documents, and they are a legal document, but they are very different than a normal legal document. They are a little bit more layman's terms, I think, so that people really can grasp that. And there's more, at least in the ones that I've seen, there's a lot more like charts, graphs, pictures to help explain whether it's a legal structure or the flow of capital or whatnot. Typically that's more emphasized than in that typical legal type of a contract.
exactly. Yeah. Sometimes we get those without any pictures and charts, and we just like to add them because it can demonstrate what you're saying in a page or two really clearly and into a chart. So yeah, that's a good point.
Yeah. So as we, I guess we're starting to come up to the end of 2024 here. What do you see over the next little while, market-wise, whether it's on the private side, the public markets? And I know that's a big question to ask, and you can't. The preface to that is that if somebody wants financial advice, they have to go to you for it and become a client. But what does that look like in the grand scheme of things in your mind?
We're watching the market very closely. There's big election coming up south of the border, and another one coming up in Canada, which will kind of dictate a little bit of our views. But interest rates are really taking a turn, starting to go down. Looks like they're going to continue to go down. So for us, that's loosened up the market a little bit. We got to the point where there's probably more buying opportunities within some businesses like Pinnacle Lifestyles. We're buying RV and cabin resorts, and we've put a hold on those. As interest rates were going up, we decided we're not even going to look at any, and we're getting a lot of small business owners approach us saying, hey, will you take on our campground here, because we'd like to retire. And as interest rates go down, it starts to make more sense for us. And I think that's going to carry across most businesses. And so I think it's going to become a really good buying opportunity over the next 12 to 18 months for many of the offerings that we have on our shelf.
Yeah, good. If you had advice to give for somebody maybe looking to enter the industry, enter the market, what would you tell them?
Do your homework. It is very important in a compliance-heavy industry to read all the regulations and take as many courses as you can. That's what I did when I started out being young. And I think it's important to be able to give good advice to investors. And so know your product, know your business in general, and just take your time, do your homework, and then you can offer a better service to all those around you.
I'll give you a little bit of time to do a selfless plug here. Why Pinnacle versus some of the other EMDs that are out there?
I think it's our experience. We got a lot of good people, been around as long or longer than all the other EMDs, and like I said, we've learned how to look at product, and sometimes it wasn't easy, and we've learned from some difficult ones. So I think it's our experience and the evolution of Pinnacle Wealth over the last 17 years, doing due diligence, and then our back office and our processing and our support team and our compliance team. We have a great marketing support, and we're using the first in the industry artificial intelligence dealing rep support. So we got a remote, basically, chatbot that is able to help specifically in this industry. And so it makes it a little bit easier for those getting started in the business to have that kind of support around you. If you start with a smaller firm, then you don't have as many people to talk to. And of course, we got lots of peers, right? We have dealing reps across Canada that you can meet with and talk to.
Yeah, and for those that don't know, each province, you'd alluded to it before, but they have different security commissions that oversee all of them. Collectively, they're relatively similar, but there are definitely differences in limits and whatnot per province. So sometimes it's a little bit tough if you don't have that understanding Canada-wide of what that looks like when you're looking at different products.
Exactly right. Yeah, it's good to have somebody local to talk to.
Yeah. Darvin, if somebody wanted to learn more about what you guys are doing or wanted to get in contact with you, where would they go for that?
Yeah, best way to find me probably is on LinkedIn, Darvin Zurfluh on LinkedIn, or go to pinnaclewealth.ca and check us out on our website.
Awesome. Well, certainly enjoy having you on the podcast today, and look forward to seeing some of the more offerings that you guys have on your plate there, and hopefully helping Canadians invest and make more money in the alternative asset space.
Excellent. Well, I appreciate the opportunity, Matt. Thanks. And thanks for everybody for tuning in. Thanks. Take care.
You've been listening to Beyond Wealth, Success Unscripted with Matt Calnan. Want to be our next guest? Visit beyondwealthpodcast.ca/guest. See you on the next episode.